We're going to calculate the stock price for Amazon using prior financial information. First, we need the market cap, 1.218 trillion. 1.218 trillion. 2442.37 is the stock price. Now, if you take the market cap divided by the stock price, you get the shares outstanding, 500 million shares outstanding. Next, we need free cash flow. And this is the best way to calculate the stock price for a company, is to estimate future free cash flow and discount that number back to today's dollars. Next, we need net income, and you can find that on the income statement. And we're pulling in 4 years of data for our model. And last is revenue. Every year they have a big jump in revenue. Now we need to look at the capital structure of Amazon. To figure out the discount rate, we need to apply to the future free cash flows. So the interest on the debt is 1.6 billion. Now let's see how much debt they have. We'll go to the balance sheet. In the liability section, a current debt, no current debt, long-term debt of 23 billion. So they pay 6.83% on the debt. That's kind of high. And now interest payments are tax deductible, so we need to find the effective tax rate. And the income before tax is 14 billion. And now the income tax of 2.4 billion. So they pay 17% of taxes. So the cost of the debt is 5.7%. And only 2% of that capital structure is debt. The other 98% is equity, which is really good. You want to have a company that doesn't have much leverage. Now let's check out the beta, the volatility of the stock. 1.35. Now the cost of equity is 12.69%. So equity is more expensive than debt, as you can see. More than double. Because equity sits lower in the capital structure of a company, therefore it's more risky. In the event of a default, debt holders are paid before equity holders. So the 12.56% number you see here, this is the price Amazon pays to obtain financing. So Amazon needs to generate at least this much in profits a year to add value to its investors. And this is the weighted average cost of capital. It's a blend of the cost of equity and the cost of debt. And this is what would have discounted the future free cash flows by. So we estimated the cash flows based off of historical information. And we estimated a terminal value, which is all the future cash flows after year 4. And we discount that back to today's dollars. And the PV is 327 billion, which is kind of low. I'm going to increase the growth rate because it is Amazon to 10%, which is kind of high, but I think that's appropriate because it's such a giant. That makes it a little more in line with the actual stock price. So it is trading at a premium, only 9%. And if you look at the historical stock price, it just keeps getting bid up, Amazon. Whether it's worth that much or not, people think the future of the company is worth more than the actual current value of the company. So you'll see some analysts saying Amazon's a buy, other analysts will say Amazon's a sell. And each analyst has their own model and their own assumptions and their own ideas on this company. But you never actually see their models. But this is my model and my opinion. So I hope you liked the video, and thanks for watching.